All right, let's jump right in. The world of global investing can feel, well, pretty noisy, right? It's cluttered. There are a million different signals coming at you. So today, we're going to cut through all of that noise and look at one very specific map for navigating this complex world.
I mean, just think about it for a second. The global market is this enormous universe, like a galaxy filled with thousands and thousands of companies, all asking for your investment. And yeah, there's a ton of opportunity in there, but let's be honest, it can also be completely overwhelming.
To put a real number on it, if you look at a big global index like the MSCI All-Country World Index, you're talking about roughly 3,000 stocks. That right there is what we mean by index clutter. It's this gigantic list of companies from all over the planet.
So, that leads to the big question, doesn't it? When you're staring at a sea of 3,000 different options, how do you even begin to find your way? How do you chart a course through all that?
So, our starting point is this massive universe of stocks. It's a landscape just packed with potential, for sure, but also a whole lot of complexity. The real challenge is figuring out how to navigate it.
To navigate a universe like that, you really need a map, some kind of clear charter. And today, we're going to explore one of those maps, the investment charter of the DSP Global Equity Fund. So, the very first thing they do is dramatically narrow the playing field. They immediately get rid of all that index clutter, shrinking that universe from about 3,000 stocks all the way down to a much more manageable 400 to 450. And how do they do that? Well, they focus only on large, established companies. We're talking typically with a market cap over $30 billion.
Now, once they've narrowed down that universe, they pull out their compass. But this isn't about guessing which way the market winds are going to blow. Nope. It's a tool with 3 solid core principles that guides every single decision they make.
And their process is actually beautifully simple. It just boils down to these 3 steps. First, like we saw, they filter that huge universe. Second, and this is so important, they insist on quality. They're looking at things like good governance, stable earnings, and they look at all that before they even think about the price. And then step 3, they wait for a sale. And believe me, they are really serious about waiting for that sale. They have this super strict rule. They will only even consider buying a great business when it's trading at a 30 to 40% discount to what they calculate its true value is. What the business is actually worth separate from its day-to-day stock price. This kind of discipline creates a really clear picture of who they are. On the left, you see what they're hunting for, those steady, long-term business builders. But honestly, that we avoid list on the right is just as important. They intentionally tune out all the macroeconomic noise, they ignore short-term trends, and they even screen out entire industries like banks and tobacco. This quote from their newsletter just nails it. It perfectly captures what their strategy is all about. It's not about being busy and trading all the time, it's about being incredibly patient, disciplined, and just waiting for that perfect moment to act. So what does being a patient egret actually look like in a real portfolio? Well, it looks like this. Almost 48% in cash as of October 2025. Now here's the key thing to understand. This is not them predicting a market crash. It's simply the result of their strict process. The egret just isn't seeing enough fish that meet its high standards at the right price, so it waits. Of course, holding that much cash has its own risk. You could miss out on a rally, but for them, that's a risk they're willing to take to avoid overpaying. Okay, so we've covered the theory. Filter for quality, wait for a big discount. But what does a portfolio built on such strict rules actually end up looking like? Let's take a peek. What you get from all that discipline is a portfolio that's very focused, what you might call concentrated. They're only aiming to hold between 30 and 50 stocks, and right now, they only own 19. This means they can know each company inside and out, but it also means that the performance of each one of those companies has a much bigger impact on the whole fund. And here they are. These are the fish that the egret decided were finally worth catching. This really makes the whole strategy concrete. You see a bunch of names you'll recognize: Amazon, Tencent, Alphabet. These are the kinds of global companies that made it through all of those tough quality and value filters.
This chart just gives you a quick visual of where the investments are located. You can see a good chunk in North America and a mix in Europe and China. But again, the thing you just can't ignore is that huge slice of the pie sitting in cash. It's a direct reflection of their patient philosophy in action.
So what does all this really mean for an individual investor? Well, the key thing is you have to zoom out. This whole strategy, it's not built for the next quarter, it's built for the long-term horizon.
So how might you actually use a fund like this? Well, the idea isn't for it to be your entire portfolio. Instead, you might consider it for the active slice of your global investments, maybe that 25 to 40% portion, to complement a core of more passive, low-cost index funds. And to really drive this long-term mindset home, the fund's newsletter features this powerful quote from Jeff Bezos. "Today, I'm working on a quarter that is going to happen in 3 years." Wow, that really says it all, doesn't it? It's about building for the future, not just reacting to whatever's happening right now. And this brings us right back to the final, most important question. And this is one for you to think about. When you look at your own approach, are you investing based on the noise and the drama of this quarter, or are you building for the next decade?